Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com gives us the rundown on the market meltdown. While a bounce back is expected, it could mean darker times ahead, especially for oil. Danielle Park, editor of the blog Juggling Dynamite, blames world debt for much of the market decline. She talks about Canada's and Australia's collapsing real estate bubbles. Polar Futures Group co-founder Victor Adair digs deep into what's happening with gold. He believes rising interest rates are the trigger for much of the action we're seeing. Plus, at the end of the show, we'll have a company showcase update from American Manganese CEO and President Larry Reaugh. We'll talk to Ross Clark right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features to our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to This Week in Money.
Good to be with you, Jim.
Ross, how long does it take for the Dow to go from record highs to its 200-day trading average?
Well, it would normally take a period of weeks and maybe even a month. But in the recent instance, we peaked on the 4th of the month, and here we were as of 1 week later, trading actually just straddling the 200-day average. Just goes to show, how light the bids were underneath the market there. And when we look at the Dow the industrials having gone to a new high a week and a half ago, and staying up there for the better part of a week. It did that with more than 50% of stocks already below their 100-day moving average. The New York Stock Exchange Index had only recovered about two-thirds of its loss from the January high into the March lows. So overall, the market really wasn't nearly as strong as the Dow Industrials would have you believe. So, we had talked about the financials, the Ameritrades, the TD Ameritrade, the E-Trade stocks, which were already showing quite a bit of weakness through the summer, and that the asset managers, the J.P. Morgans, the Morgan Stanleys, those were all rolling over. So, all you needed was a catalyst out there to start the break. And I guess, commentary from the Fed regarding the rise in rates, the reaction to a 340 to 345 yield in the 20 and 30-year bond, and a 3.25 on the 10-year. Even though we have been walking up in terms of rates for months and months, it was that pop of 20 or 30 basis points right at the tail end that caught everybody's attention. So, here we are, a very quick correction, but we've got the kind of oversold readings that we would see on the Dow and the S&P that should provide a bounce next week. But I think looking at the Dow, you probably got a resistance starting at about 26,000. I'd be very, very surprised to see it make itself back to new highs without going back down and retesting support.
A few weeks ago, Tim Cyclesman Wood told us that he suspected that the foundation of the stock market was very weak. He said for the 73 stocks that went up that week, 262 were going down.
Oh, yeah. I mean, the diversification here in terms of the inability of the broad market to perform. I mean, this is what you tend to see at the tail end of runs, where a few stocks are making headlines. I mean, think back to the spring. It was the FANG group of stocks that was creating all the headlines, how well they were doing. But that index topped out at the end of June, early July, And really, there was very, very little leadership since then. You were doing reasonably well in utilities up until about a week ago. And, the item that had been hot and has finally run out of some steam here have been the marijuana stocks, which we're coming up to the middle of next week as the legalization of marijuana in Canada. And there's only one or two of the stocks in that group that still have much in the way of strong momentum on the upside. So I would suspect that this becomes a sell the news type of item, just like the NAFTA agreement became a sell the news for things like the Canadian auto parts manufacturers a week and a half ago.
And everything can't be too happy there if Mr. Stronach is suing his daughter Belinda for the way she's running his company.
Right. Well, he stepped down a few years ago, and it's this is an organization that he built from the ground up. He just had nothing to start with when he came to Canada. It was an amazing growth story there. But the family relationships are very difficult when it comes to business. And take a look at the other items that moved this week with the stock market having that hard correction. Gold had one of its best days in months, had about a $30 move on Wednesday, Thursday, which is very typical. If you get a 5% move in the equity market down within 2 to 3 weeks, or a quick kind of move like that, you invariably get a pop in the gold market. Now, if the equity market there's this bounce that I'm thinking we can have, if it starts to fail and we go down to take out the current support that we saw on Thursday, Friday, you probably get another group of buyers coming into that gold market and the mining stocks, which also had just an excellent midweek move there. Resistance we would expect in gold. The key one is going to be up around the 1255 level. It's about $30 from where it closed off this week. If it gets a spike up into there, I would suggest that anybody that's been picking up precious metals look to trade out of them at that point. And hopefully with the commitment of traders numbers, the way they are so biased right now with speculative positions still short a net 38,000 contracts and commercials net long 26,000, we still have the makings for a really good short covering rally, more than the one that we saw in the middle of the week.
What do you think is going to happen to oil?
Well, I've been looking at oil as being in its 10-year cycle, which in the fourth quarter of the eighth year of the decade, which is where we are this year, the market tends to have a break of about 30% from an interim high into a low, and that can carry you out. It's in the fourth quarter or into January. With oil having been up to 76 and given back half of the gain from the summer low, if it were to violate the $70 to $71 level, I think that will now be the catalyst point for an extended move to the downside. And if we could be looking at oil in the 50s at some point in the next 3 months, that should present just an exceptional buying opportunity. And we've shown a chart of how the oil market is just following a few months behind the pattern that we've seen in copper. And if you recall back in the spring, copper had a secondary run up to $3.30 and failed off of that down into the 260s. And it was as it came down through the $3.05 to $3 level that it really, really started to show its major signs of weakness. The pattern we've got in oil right now is similar to what we saw just after the top at 330 in the copper market. So if it were to start pushing through that $70, $71 level, it should gain some momentum down through there, and then I think it just becomes a great opportunity for the fourth quarter.
Ross, thank you so much for chatting with us.
Always good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Danielle Park, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm speaking with Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
At the time of our interview, the U.S. stock market had 6 down days. First time that's happened since President Trump was elected. What's behind the decline?
Oh my goodness, Jim. This has so nothing to do with President Trump. I was making jokes that it had nothing to do with President Trump when he was taking the credit for the upside, and I was tweeting that he'll be sure to distance himself from any downside. He likes to take credit for any gains, but I said we'll make an excuse as to why it's not his fault when it corrects. And sure enough, this week he was making these outlandish comments about it's the Federal Reserve's fault and the Federal Reserve has gone crazy and all this sort of thing, because they've been tightening rates. And of course the truth of the matter is that the entire rally that's happened in the past few years has been directly related to lax monetary policy by low rates and QE from the world central banks. It actually didn't have a thing to do with the politicians. It didn't have a lot to do with growth in the world or, sales, revenue, household stability. None of that stuff was in the mix. It was all about loose dollars and speculative behavior and people willing to risk and take bets that had a very low probability of winning in just the hopes that they might. And so you get this farcical conclusion now where, ultimately they can't have zero rates forever, although we damn near did, Jim. I mean, we had them for about a decade. That's the longest period of low rates that we've ever seen in the history of markets. So, rates have been, they should have continued hiking in 2011-12, but they kept chickening out every time the stock market took a dip. And what's happened now, of course, is the world has added trillions and trillions and trillions more debt now than it had a decade ago. And that's a direct consequence of lax monetary policy and speculative behavior. So this market had it long coming that the mean reversion cycle would begin. I actually think that this whole, we started into a down cycle in January. From the January peak in 2018 at the start of the year, markets sold off heavily, if you recall, Jim, into February. And I think that was, a warning shot, another opportunity for people to assess the risk exposure and danger in their accounts and whether or not they might want to, add some more secure deposits and that sort of thing. But many people just, when the market bounced after February, they forgot all about that again and went back to long always, borrowing to put more money in the stock market. Margin debt today 160% higher than it was at the tech bubble peak. Like, this is just lunatic fringe. And so, I think it's been a suckers rally really all since February when it came back. Again, it had nothing to do with Mr. Trump and all the nonsense that people talk about. It was all this return to speculative behavior. And the Federal Reserve is convinced that it's, given the elixir of low rates long enough, and they really want to get some more semblance of normalcy in the yield curve before the next recession hits, and they know they're running out of runway. So they continue to hike, and, U.S. mortgage rates went above 5% this week, Jim. The reality in Canada is just as stark in terms of, today a family with $125,000 household income and a 20% down payment can afford to buy a house for $625,000. Still a ton historically, but, relative to what they could have bought in 2015 when rates were at the all-time low, they could have bought a house for $800,000. So what that means is that property prices are now in the downstroke, and they should be because they got excessively valued, as we've spoke of many times. The affordability factor is lunatic. The average one-bedroom apartment in Toronto now rents for more than $2,400 a month. I'm sure Vancouver is equally as bad or worse, perhaps. So we've really priced everybody out of the affordability of housing. They're drowning in debt, and we're seeing the fallout. We're seeing things like car sales plunging. Used car sales, because there's so many cars coming on the market now off of leases. They're down heavily. Car company shares have been falling even before this latest rout because the sales numbers are so weak. So when people have just gorged themselves on too much debt and they're struggling to keep up, and now payments have jumped this much, they're not able to afford other consumption. They're barely able to afford the roof over their head. They cut back on other spending, and ultimately they can't save. So we've really just made this period of slow growth. And what's more, the IMF and major organizations around that look at economic activity are in fact cutting their global forecasts as we speak. Recently, the IMF cut its global growth forecast to 3.7 in 2018-19. And that, of course, doesn't include any prospect of recession. Of course, they never see recessions coming. Because the stock market has become almost the trigger for what is, these extended and deep economic downturns now that the world is so levered and dependent on inflated asset values. So, long story short, it wasn't Mr. Trump that made the stock market go up. It was just an excuse in the last couple of years on, hope and speculation. And indeed, it isn't the Federal Reserve's fault that the stock market is going down. Any reasonably prudent person would in fact say that it was their fault for keeping rates so low for so long, that allowed all these asset bubbles to build, that allowed the debt plague to infect the globe. And it is a responsible move now to try and increase rates and curb all this speculative frenzy that's wasted so much of our money and time. And so, I knew Mr. Trump would do this because he's the most irresponsible financial person that we could possibly have at the helm. And, he was unduly taking credit. And of course, he's unduly blaming now the Federal Reserve, but in the exact wrong way.
Is this a sign that there's a crash about to happen, or is this just a dip and another opportunity to buy some big names at a lower price?
See, no one knows the way in which this cycle will deflate. All I can tell you is that it will. So it could happen in a series of dramatic sell-offs where, it would be nothing to see. U.S. markets are so inflated, emerging markets and the rest of the world are essentially been selling off since January. The U.S. outperformance has been this one market in the world that has held up as rates have risen to date. So it would be, if you look at to answer your question, I think this is a drop in the bucket so far of what we're likely to see. The cycle has gone on, as we've discussed before, longer than any other expansion cycle in history, even though it has done so at about half the global growth rate that traditionally, or in the prior decade before that. So the long period has been purchased by this extension of credit, which is now going to extend the slowdown period. So we could get some major wipeouts and 87 style downside action, or we could have a more 2000 to 2003 style grind lower, with a lot of sharp drops and then sucker rallies back, sharp drops and sucker rallies back. But one thing I'm pretty confident about is that valuations are headed lower over time from here, that asset prices are heading down, that we're entering a period where people are going to continually lose money if they remain risk exposed. And at the end of that, it won't be until everyone is absolutely fed up and wanting completely out that we'll see the valuations finally come into investment quality, when dividend yields will be higher and the opportunities will be plentiful. But unfortunately, as history shows, by then very few people will be willing, liquid, or able to take advantage of the opportunity. So, you can't be in for every penny and then out for all the, and miss all the downside. If you're holding at the top of these speculative runs, typically by the time you think you're going to get out, everyone's already selling in panic. And, it's interesting because I've been saying since the late 90s we were heading into a secular bear period in stocks, and people have taken the evidence of the U.S. stock market's rally the past couple of years to new highs as somehow evidence to contradict the thesis that we're in this secular bear period. And I've held steadfast in belief that we were still within it. And the reasons are that because of the high valuations that we saw in 2000 and we are back there today, we have not made the progress we need to start from a new secular expansion from low valuations when dividend yields are attractive, when asset prices are within the realm of investment quality. We aren't nearly there yet. In fact, we're back nearly where we were in 2000 in terms of unattractive investment conditions. And the fact is though, with all this fire and fury, with all this up and down and all this volatility, the TSX today, the Toronto Stock Exchange, our Canadian stock market, is 2%, Jim, at the moment, 2% above where it was 10 years ago, okay, in September of 2008. And just a 26% bear market drop from here would take the TSX back to where it was in September 2000. So that was the peak of that secular bull cycle. And the TSX, for all the up and down, in and out and trauma that's been caused, and, people buying products for exposure to it. And the reality is it's done better in government bonds and GICs for the last 20 years. That's the reality of it. So what we have to do is be aware that you can't just buy anything at all times at every price. That isn't investing. That's craziness. That's reckless behavior. That's more certain to have a negative effect on your finances over time. And as I was writing on the blog this week, it's essential that people comprehend when we're in these kind of environments where central banks have pumped the world full of credit, where speculative behavior has been widely prevalent everywhere, and where leaders have been saying the most ridiculous things, like taking credit for upcycle and not looking at all the debt and problems that are coming with that. What you end up with is this extremely correlated economy where you have, your home prices are in a bubble, the stock market's in a bubble, corporate debt's in a bubble, everything is not going to be long for this world at these levels, and people have put all their savings into these overvalued assets. So what tends to happen is when you get that much dependence in an economy, certainly like in Australia and Canada, and certainly like you had in the U.S. in 06, and again to some large degree today in the U.S., what ends up happening is asset prices correct, and the economy takes a dump because it's so levered and dependent, and then people start losing business income and employment because of this. So all of a sudden, all your eggs are in the one basket, and the one basket is dropping. This is just not prudent financial management, right? So if you can't control the amount of business that you get, the amount of whether you get laid off or not, what you can control is how correlated your savings are to this cycle. And what you ultimately want is to have your savings in a negative correlation to your income flow. So if your income flow is at risk of a downturn because we're going into a slowdown in the economy, you want to make sure that your savings are as liquid and non-correlated as possible. And that means you can't be buying yet. You can't be holding and hoping, because otherwise everything falls together and you're very destabilized and the economy is very destabilized. And that's where we are. We're at risk of that exact scenario today.
We'll have more with Danielle Park when This Week in Money returns.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Danielle Park. In your blog, Juggling Dynamite, you talk about the Australian housing crash, about how they could lose 40% of their investment. Is Canada facing the same thing?
So this is an interesting parallel, right? So 60 Minutes Australia did a segment on the housing crisis that's already underway in Australia. And indeed, they've seen this leap in foreclosures and property prices in some areas already, underwater. But Australia, too, is almost like an extenuated example of the conditions that we've had in Canada for very many of the same catalysts. The great commodities boom that came in the early 2000s and went into 2008 and then rallied again into 11. All that brought a great deal of cash flow and foreign investment and interest into places like Australia, New Zealand, and Canada for many of the same reasons. And what happened was that the debt-on-debt scenario just really ballooned. And so people began speculating in real estate with borrowed money because they could, because the banks were lax in their lending, because rates were at all-time lows. And people began to believe, as they did in 2006 in the U.S., that housing never went down. Even the head of the central bank, Ben Bernanke, before the Congress gave testimony in 2005-6, or Greenspan as well, his predecessor, that housing didn't go down. And they were, of course, horrendously wrong. And indeed, when you've got any asset that's this over-levered and indebted and overvalued, always mean reverts eventually. It's just a question of how long it takes. Now in Australia, they've had, they didn't even get the pullback in 2008 that we got in Canada. If you remember, we had a pullback in Canadian real estate, for about 8 or 9 months in the recession of 2008. And then we rallied strongly from there, Jim. Australia didn't even get that much of a pullback. They had so much of an infiltration of Asian capital and speculative behavior and low rates. But indeed, they're getting it now. So again, it's this tether of, home prices and rents have to connect back to income and affordability at some point. And there's a multiple max at which a family or an individual tops out, where they literally cannot afford the roof over their head if prices are that high. And that's where we are in many of the major cities in Australia, parts of New Zealand, and certainly in a lot of the parts of Canada. And once you get that, revelation that people were doing things like interest only mortgages. There's a part in that 60-minute segment that highlights how some people were planning a retirement income or planning to continue through retirement by owning a bunch of properties with interest only mortgages, right? That they were only servicing the debt, they weren't repaying it in any way, and trying to live off the difference between the rental income and the costs of carry on those properties. Well, of course, now that interest rates have gone up, there's zero net income coming off those properties. And so now you've got this horrendous scenario where the prices dropped below what's owed on it, and people are having negative carry to try and keep those homes afloat. And of course, what happens, Jim, is then they're forced to sell, and they're looking for buyers, and buyers have suddenly evaporated, right? So this is certainly the case. It's already underway in Australia. Many people who are close to the numbers there and realistic about it are saying it would be quite normal to see homes decline up to 40% in many areas. That's not that shocking. We saw homes decline 60% in Ireland, for example, in 2008, 60% in the U.S., and many other areas. And that's a function strictly of the math of when things become as overvalued as this relative to income and what happens in the mean reversion cycle. So in Canada, we did have a period of interest-only loans, if you remember, Jim, for a short period. I think it was in 2006-07. We brought it in that you could have interest-only mortgages, and then the government quickly reversed because thankfully they saw the disaster that was unfolding finally in the United States, and they retraced on that policy. But there are still many people who were holding negative carry properties where the expenses are more than they could get in the rent or income. And certainly most people with personal use properties have very negative carry, right? Because they have a shelter, but ultimately they're shelling out a ton of money every month for the mortgage, the interest, the maintenance, the utilities, the taxes, the whole thing. And so when those prices start to go the other way, their aptitude for holding on to them is very tenuous, and indeed they all sort of look to sell at the same time, and that's what really brings the downward pressure. So it's interesting whether we'll see as much downside as the Australian market. That's up to see. But I think that Canada certainly I think that the most likely scenario is that we'll get a sharp dropping period. We've already seen that start in many areas in the GTA area, Greater Toronto area, near where I live, where properties are down about 20% in some price brackets, certainly from where they were, say in 2017. But you could easily see another 20-30% decline from here, because as I look at the properties that are listed in this area, they're still obscenely valued. The most basic small, subdivision style house is routinely selling for more than $600,000 and $700,000 here. It's really quite freakish.
We'll have more with Danielle Park next on This Week in Money.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Danielle Park. Danielle, pot is going to be legal on Wednesday. What kind of a market is that for people to get into? Are the people in it now going to get rich? Are they going to see some disasters? What's going to happen?
Well, in general, there's certainly going to be some people who make a mint off of things like pot stocks, but I would note that timing is absolutely everything, and the fact that people are soon going to be able to consume pot on a legal basis doesn't go nearly far enough to address all of the uncertainties in the business model, all the regulatory risks and hiccups that are coming. And I think it's more telling, frankly, if you consider, I read an article recently, this week, I believe, about how many U.S. pot companies and investors, early startups, are clamoring now to list on the TSX Venture, right, in Canada, because there's still a federal ban on marijuana cannabis companies in America. So they're clamoring to list on the venture. Now, bells should be going off in your head when companies are clamoring to come to market, because what most people don't appreciate about the stock market is the very best way to become a gazillionaire in the stock market is to sell your company to it. In other words, you give the shares to public investors and you take out the cash. And that's what everyone in the early startup phases is trying to do now before this gravy train runs out, before the stock market, loses its lift on free rates and speculative fervor. They want to take the cash and run. So they're trying to sell it to the public. It's like hot potatoes, Jim. They're trying to toss them at the public and get the hell out of there. So that should be a warning sign to anyone that's interested in investing in the space, not just speculating and, hoping that they win at the blackjack table, but actually, if they're hoping that they can invest in it and make a positive return, they really have to be very leery of times like this where there's all this frenzy and free money and speculation, and insiders are selling with hands and feet at every turn. So, you don't want to be left holding that hot potato. Far better to make a list of the companies or ETFs in the sector, things that you may be interested in owning, and then just keep powder dry on the side with those earmarks or, those areas that you think are going to be a long-term investment story, and wait for this mean reversion process to happen. Because there's no point in buying, as I've said many, many times, even, fully developed companies can drop like stones, and routinely do when we get into the mean reversion part of a market cycle. It's got nothing to do with whether they're particularly well managed, whether they have a product that everyone wants. That really becomes irrelevant when you're in a rising rate, tightening conditions that's causing forced selling across the board. So better to let the forced selling happen, let the price mean reversion take place, and then that's when you deploy your liquid cash and pick up the things that you think are a longer term investment story.
Danielle, no embarrassment for selling now, taking your cash and sitting on the sidelines to see how everything shakes out?
Well, the fact of the matter is that most of the gains that have been seen in, for example, the U.S. market in the last year or two, as I said, were not justified and were all built on buybacks and leverage. So they will mean revert. The rest of the world is already headed down. Canada is now back to the level, as I said, it was 10 years ago. You haven't missed a thing. You don't miss out by stepping out of insane risk and collecting compounding interest on things that are guaranteed in principle to pay you something. So the whole equity market can become an intense Ponzi scheme when everyone's just throwing capital and no one's paying attention to valuations. Very similar to when people are buying real estate without any care for whether the rents can carry the property or whether it makes sense on a valuation to income basis. They're just buying because they could get the money from, borrow it and throw it in and, hope that it goes up. Those are the wrong conditions. So if you are an investor, you tend to not want to participate in those types of Ponzi schemes because they can be extraordinarily destructive to capital over the longer run. And you're more inclined to take, bird in the hand, keep the capital safe, put it into GIC-like deposits and money markets and, government bonds in Canada recently. You can buy, with them yielding 3% and more. These are highly liquid places that capital flows. And indeed, when you see everything sell off, there's no diversity benefit in holding different packets of this stuff. If you look at your statements in the sell-off that's happened in October so far, I always say this to people, on the big red days, look at your holdings. If everything in there is dropping together, you know that you don't have any meaningful diversity benefit. In other words, you've got a highly correlated portfolio of risk assets that are at all-time record valuations. So that should be a warning sign that you want to take risk off, that you want to build up liquid savings, and that you want to earmark for what it is you want to buy, but wait till those clearance sales come. Because it's overdue, they will come, and he and she who has the patience and fortitude to prepare for them now will reap great benefits from them later, and everybody else, unfortunately, will be taken offside.
Danielle, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. She's the president of Venable Park Investment Council Incorporated. She was speaking to us from the Toronto area. Coming up, Victor Adair, next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYVresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor.
Thank you, Jim. Good to talk with you.
Victor, what do you think was responsible for the giant drop in the stock markets the past week?
I think the list of suspects right at the top is it's rising interest rates. In the United States, the yield, both the nominal yield and the real yield, and that's very important, that's what you get when you subtract inflation out of it, on the 10-year Treasury are at 7-year highs. That is a market that has been trending lower. In other words, yields have gone from their highs back around Paul Volcker's time in 1981 to the historic lows we hit in the summer of 2016. And we've had that downtrend. Well, that downtrend, the price action here has broken out to the upside in terms of yield. I think the market has really begun to almost reluctantly take the view that Powell is a different head of the Federal Reserve than Bernanke, Yellen that have gone before him, and that this Fed is determined to tighten monetary policy. They're running down their balance sheet. They're raising short-term interest rates, against an environment where on the fiscal side, the government is really stimulating the economy. So there's room, certainly, for the Fed to keep pushing up, interest rates. There's a couple of reasons. I mean, rising interest rates is one of them, but rising interest rates in an environment where I think there has been excesses, in terms of speculation. My big picture view, the way I look at the world is that way more money has been borrowed than is ever going to get paid back. And we've had these really, really, really low interest rates for 10 years thereabouts. Remember back in 2016, we had over $12 trillion worth of sovereign debt trading at negative yields. We have been in an environment of astonishingly low interest rates that's caused people to reach for yield. You can't get anything by putting your money in a bank account. People have gone out, they've taken chances, they've been rewarded for taking chances, so they've taken even more chances. So I think really low interest rates created some, call it a misallocation of capital across a number of markets. And then when you have a day or a week like this come along and there's some stresses in the market, some of the things that sort of went up the fastest, get knocked down the quickest. So, and in terms of that, I mean, the NASDAQ right now trading at a 3-month low. The Dow is still 1,500 points or so above where it was three months ago. So there's been these speculative excesses. And one final thing. All around the world, stock markets have been falling for months. And let's just leave Japan out of that because they've been sort of keeping pace with the Americans. But in emerging markets and throughout Asia, Europe, markets, broke back in the January-February period when the American markets broke. But as American markets came back to new all-time highs, emerging markets in particular just kept trending lower and lower and lower. So there's been this huge divergence between what's been going on with the stock market in the United States and the rest of the world, again, outside of Japan. So I think in a way, the American market is catching up to what's happened in the rest of the world as far as price action in the stock indices is concerned.
We'll have more with Victor Adair right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Victor Adair. Victor, what have rising interest rates done to the currency markets?
I think, let me answer it this way. I see the currency markets kind of in two parts. One is what I call emerging markets, and then the other part would be what we call, say, the G10 or the developed country markets. The emerging markets in particular have been clobbered this year. And that's the realization that, let's say this, that they've borrowed trillions of U.S. dollars. And as interest rates rise and the U.S. dollar rises, that's been a double whammy, as it were, against a lot of emerging markets. And that's caused them to really weaken, whereas they say the G10 markets are lower, but, not nearly so much. So I think that's been the main thing that rising interest rates in the States has done. It's kind of put a bid in the U.S. dollar or caused people who've got obligations in U.S. dollars, but, their receivables or their income is in another currency. They're in a tough place. So the market's adjusted by driving those currencies down against the U.S. dollar.
The euro currency has been falling against the U.S. dollar, with many analysts blaming the new government in Italy. Is that the problem?
That's certainly part of the problem. For decades, really, after the Second World War, the Mediterranean countries, let's call it, Greece, Spain, Italy, Portugal, to some degree France, those countries were able to devalue their currencies against the Deutsche Mark, so they could remain competitive with Germany and sort of maintain their lifestyle. Under the euro framework, they couldn't do that anymore, but the stresses and strains were still there. So, you've got in those countries much higher unemployment, low, if any, real economic growth. And now we've got this new government elected in Italy, that wants to have a more aggressive fiscal policy. And the way they tell the story, you got to be sympathetic. They're saying, hey, the roads are full of potholes, the bridges are falling down, and we need to do this. And so this more aggressive policy, the bureaucrats in Brussels are saying, no, they don't want that. They like austerity. It kind of reminds us of Greece. When the Greeks got into problems, a lot of people were saying what they really need to do is leave the euro, go back to the drachma, really devalue it, and, they could motor along. So in this environment, the Italians can't do that. The stock market in Italy, the bond market in Italy getting clobbered relative to, say, the stock markets in Germany. The thought has been that maybe Italy leaves the euro. I mean, that would be a pretty dramatic step. But the way I'm looking at this, actually, is what is happening in Italy right now vis-a-vis Brussels is just part of a process that could very well see the rest of Europe take a more aggressive fiscal policy. Like the bureaucrats in Brussels have to change or get replaced or ignored or what have you. I mean, the Europeans got to be looking at what's happened in America and saying, gee, that seems to be working over there. The economy is really strong, even though the government's running these substantial deficits with expansionary fiscal policy. I think there's a good chance that we'll go in that direction. I mean, we might even see Canada, for crying out loud, take some steps like lower our taxes so that we could become more competitive with the United States.
The finance minister, Bill Morneau, says in his November financial update, he'll be looking at ways to make Canada more competitive. Is that the key step, at least keeping our taxes in tune with the U.S.?
I was at a conference an oil and gas conference with Joseph Schachter, my good friend in Alberta here 2 weeks ago. And I listened to the chief executive officer of one very successful oil and gas company. And he said to the room, we've actually done the numbers and had a look and thought, should we move our head office to the United States? And when we look at it, we see we would pay millions less taxes. And that's just on the corporate side. And then for all of the senior executive collectively would pay millions less taxes. And he said, we've looked at it, haven't done anything yet. We'll see what happens in Canada. That was one company. I mean, this has got to be in the thoughts and hearts and minds of people across this country that, we're paying a lot of taxes, and compared to the United States, maybe you can move.
We'll have more with Victor Adair right after the break.
Vadic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vadic's management has extensive potash exploration and development experience in Thailand. Vadic will have marketing advantage compared to Western producers. Drill program commences this spring. Vadic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vadicventures.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Victor Adair. Victor, the Canadian dollar jumped to a 4-month high following the agreement in principle for a revised trade deal with Mexico and the U.S., but since then has fallen more than a cent. What are your thoughts on the Canuck buck?
Well, the NAFTA, as you say, the proposed deal or whatever, it was a relief. Okay, I mean, compared to what might have happened, we came out smelling like roses. I mean, if Trump had got cranky and decided to hit the Canadian auto exports with a 25% tariff or something, that would have been a real poke in the eye. So NAFTA removed, this proposed deal on NAFTA removed one of the uncertainties that Polos has been talking about, and to some degree maybe opened the door to Polos being able to raise interest rates more in Canada than he would have otherwise. So, that was Canadian dollar supportive or bullish. The announcement around the same time of this massive LNG project up in Kitimat led by a consortium led by Shell, I think was also bullish for Canada. And then on the Monday, again around that same time, Quebec voted in a more business-friendly government. So you had several things kind of happen all at one time, and the Canadian dollar jumped from roughly 76.5 cents to 78 cents. For me, I took that as an opportunity to get back on the short side of Canada. I mean, it was sort of a case of buy the rumor, sell the fact. Something here that's kind of below the radar, although I hear people talk about it more and more, is what we get for our oil. As I was just mentioning, having an opportunity to export natural gas to another customer is a great thing. We've still only got one customer for oil, and that's America. And Western Canada Select, that's one of the benchmarks for the crude oil we produce here, is trading at an historic discount to the WTI price at around $44. So if you see on the news that WTI is $74 in New York, that means Canada's getting $30 a barrel for our Western Select, and that's just not good for our terms of trade. I've been on balance a U.S. dollar bull this year against different currencies, and Canada's just being short Canada, or say it the other way around. I've bought U.S. dollars against Canada, and to me that's a trading stance I like to have.
Speaking of Western Texas crude, are you bullish or bearish on crude oil?
You know, I'm kind of ambivalent, honestly, right here. Although we Drew and I that's my son, Drew and I. We do some things together, and in one of the accounts that he runs, we bought some puts on crude oil last week. I mean, we had WTI trade to a 4-year high of about $77 last week, just short of $77. In terms of supply and demand, it seems like we're pretty close to being in balance. That is on a global basis. On the supply side, the concerns obviously are, you know, how much oil can Iran export? And if they can't export it, is there some oil that can come from somewhere that can be substituted? And at this point, the people certainly that are bullish on crude feel as though the other members of OPEC either are unwilling or unable to make up for a shortfall from Iran. Maybe then on the demand side, you know, if the global economy weakens, demand falls off a bit, and that could take prices lower. So what I'm doing really with crude is small, and I'm really watching the price action to see if I want to do something. I mean, if this break in stock markets that we see gather some momentum, that will, I think, put pressure on crude oil prices. From a different perspective, longer term, I mean, the next couple of years, I could really see a bullish argument for crude, and I know Joseph Schachter really kind of has given me this idea, and I give him full credit. But I mean, we have run down exploration efforts so that the reserves, as it were, that are known around the world are at low levels. And if consumption, you know, continues like the pace it's at, that'll really put pressure on prices to go higher. And especially, say, in some emerging markets like India right now, which is using, relative to their population base, very little oil and probably will use a lot more. So, and you know, Jim, actually, that gives me an idea here. Just I should mention, you know, I trade very actively in the markets. I mean, I don't put a trade on with the idea of taking it off today, but I could have a trade on and take it off a couple of days later. One of the old expressions we had in the market is, you know, you've got strong opinions. You just hold them rather weakly. So for me, when I'm trading, I'm trying to make money. I'm trading my own accounts. You know, if I buy something and it goes up, you know, I like that. If it goes down, I don't like it, and I'll kick it out. I'll kick out a trade that's going against me, even if I thought I had a great brainwave that inspired me to buy it in the first place. So, and then on the other side, if I bought something and it's going my way, I tend to hang on to it because you never know how far it'll go, and even try to find a spot to add to my position. So when I'm talking about I've got an idea, if I'm bullish or bearish on something, you know, my time frame can be anything from a few days to, you know, multi-year. But on my trading side, even if I'm really bullish on something and I buy it and it goes down, bang, you know, I'm out of it. It's gone. I just don't like hanging on to a trade that's not working.
Before we wrap up, we'd like to hear what you think about gold. It fell about $200 from April to August, and since then has done nothing. What's it going to do?
Well, it's kind of gone sideways, I guess, for the last 6 weeks or so. In April of this year, gold was trading above $1,360. That was just about a 2-year high. You had to go back to the summer of 2016, that period of time when we had historically low interest rates. And not only that, but from the lows that we made in December of 2015, and those were about 6-year lows, for the next run from those lows, December 15 to the summer of 16, you had a massive wave of speculators come into the gold market, like bigger than, we see this in the futures, we can measure it, biggest rush of speculators into the market we'd seen ever. And then, you know, that kind of petered out as prices traded off from those summer 16 highs. In April of this year, the U.S. dollar started to rise against most currencies, and that put pressure on the gold price. And I think the rising U.S. dollar from April through August is exactly what pushed down the U.S. dollar price of gold by about $200 an ounce. And it was interesting to note that in April of this year was when the trade war pressures really started to build. And I think if you just say, one thing led the other, that those trade war pressures seem to give the U.S. dollar a bid. So as I said, gold's gone sideways for the past few weeks. In a way, I'm surprised, I should say, that it hasn't been weaker, because in the past few weeks we've seen real interest rates at a 7-year high, and they've gone sharply higher actually in that period of time, the last few weeks, and that's usually a serious headwind for gold. So if you've got a strong U.S. dollar and high real interest rates, gold ought to be falling. So, I think it's done better than you would have thought otherwise. And so here's maybe a good way to wrap up. I've mentioned on this show a few times this year that since 2011, gold has fallen about 75% in terms of the S&P 500 stock index. Now that's a combination, obviously, of gold price falling down and the stock market rising. And I see here the past couple of weeks, that ratio has started to turn up a bit. Now that's going to be more due to the stock market falling than gold rallying, but it's just maybe that gold is getting a bit of a reaching for safety bid after being unloved for years.
Victor, what about Thursday's mini rally in gold?
Well, that was very interesting. The gold price jumped $40 from the low it had on Monday to the high it had on Thursday, and the lion's share that came on the Thursday. That rally broke gold out of the sideways range that it's been in for the past 2 months or so. Also broke the downtrend line that's been in place since last April. And that rally came. The U.S. dollar had been weakening a little bit for 2 days. It came after Trump took a cheap shot at the Fed. Speculators in the COMEX gold futures market have been net short, I'd say, for the last several weeks, and that's for the first time in, say, 10 years or so. So some of that rally we had on Thursday may have been short covering. We've talked about this gold being down 75% against the S&P. I think, it might be a case of people reaching for yield. I should say, reaching for safety instead of reaching for yield. I thought it was just also really interesting that gold rallied this week while the stock market fell. You might think, typically that actually we saw, for instance, back in January, February, when we had the sharp drop in the stock market, gold also took a tumble, fell $80 or so. And the other thought is I've seen many times when the stock market takes a hit like this, gold goes down as well because people are selling their gold positions. I'm going to say that's paper gold positions to finance margin calls they might have over in the stock market. Well, of course, this time around, the speculators were net short, so they didn't need to sell any gold. They didn't have any gold to sell to finance their margins. It was an interesting turn of events. We'll see if it has any legs. That's the thing. I don't know. It might have just been a one-day wonder, but I have a sense that, there's something bigger going on here, and I'm going to be paying very close attention to the gold market.
Chatting off air, you said people you were talking to in Calgary were really happy to see the super LNG project go ahead for BC's Kitimat area. What's your opinion of it, and does it bode good news for the entire Canadian gas industry?
Absolutely, it does. I mean, when you only got one customer, they can tell you how much they're going to pay. But if you've got more customers, you've got a better chance of getting better prices. And our resource industry here, let's call it the oil and gas industry, has had a really tough few years with prices down as much as they've been. So, the old what goes around comes around and all that sort of thing. But if you have a strong energy market in Canada, that puts a bid in the Canadian dollar that causes people to go to the car dealer and buy a new pickup truck, and on and on and on. It's very good for the economy, and revenues go to the government, so the governments have, more money to spend, and they don't have to tax people as much, they can get royalties on that. So yeah, absolutely. And there's some other projects, and I'm not the expert on this, but some other projects up in the same area that are looking to take advantage of this arbitrage of selling relatively cheap gas from Canada into a market in Asia where prices are a lot higher. The trick is to get it from point A to point B. You've got to go through the process of making it into LNG from gas, and that's very expensive to build the plants and to transport it. But this is a big project, and yes, I think it's very good for Canada.
Victor, thank you so much for chatting with us.
Jim, thank you. Always a pleasure. Talk to you again.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Danielle Park, and Victor Adair. And thank you for listening. If you have any questions for the show, you can send them to info@howstreet.com. Plus, right at the end of the show, we'll have a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Jim, it's always a pleasure to be on the show.
Larry, you received some good news today. What is it?
Well, the good news is that our pilot plant and our work on our process and the eventual new IPs that we'll develop for it was released a couple of days ago. And unfortunately, it happened right at the time the market traded 800 plus points, and then another 500 yesterday. So what I'd like to do is just say that really I feel that our release was a great update. It was very positive, and we're moving ahead with our process. But I'd like to mention what's happening in the market, too, because I think that's at the top of everybody's mind. The market went down about 1,300 plus points in the last 2 days. Today it's showing green. It's not a staggering increase, but it shows that at least for today it's bottomed. And I'm hoping if it hasn't bottomed at this level, that it will bottom at 24,000, and which would probably be there in not too long a time. Other than that, if everybody's back bullish again and the news out there gets more bullish, then we could be seeing another rally in the Dow, and hopefully all the other markets would follow that. But it's a bit unnerving to shareholders when they see this rapid drop in the market. But it's certainly not the first. It won't be the last. And it's how you interpret the rationales, the reasons for it. And the reasons are the same old. The sanctions, and the trade wars that Trump's involved in. But, that's a sideshow, really. The market was overheated. It's risen quite a bit in the last, several years, but recently it has been making new highs. A correction is healthy. And, I've been playing the markets for 50 years, and I see this as a healthy correction, and it's not something to get very concerned about. So, about what I have to say in the market. Like I say, it's stopped the blood flow today. It's stymied that, and let's hope this continues on. But even if it does fall a little bit further, then it's not the end of the world, I don't think, in my experience. So it's I think this weekend having the market in the green area, hopefully it remains there. This is we're 2 hours till the close of the market, so it may not be green at the end of the day. But currently, I'm pretty happy with the way it is. Back to our press release. The new IP that's coming out, people have to remember that, we had done a lot of work on the recovery of materials, but we hadn't done a lot of work on the how to prepare the scraps for treatment. And that was a long, expensive, lengthy process that we went through. The new IP will develop out of it, but we had to, the scraps come in a certain size. We had to resize the scraps and, and do several tests in order to get the aluminum out of the mix, and we were successful in doing that. So that is one of the things that you can't really estimate when it's your first shot at doing it in any kind of a commercial form. So we're happy that we've overcome that block. Now we can order the final pieces for the pilot plant. Some of them are still in the process of being fabricated and delivered. That'll be a few weeks. But, we had to do the work in order to finish off the flow chart. And that is now complete. So we're looking forward to a good fall and more progress and getting the pilot plant up and going and processing material. I know that I said something like a kilogram a day, but actually that was a kilogram an hour. And that's what we estimated for our initial plant, a kilogram an hour. We ended up doing 20 kilograms an hour. So the plant didn't run as long as we thought it was going to run, and that's for the manganese. So I'm hoping that we'll get up at least half that amount going through an hour, and which would shorten, a ton is a lot of material, and 24 kilograms a day, 24 hours, that's going to be a few days of work, and if you could reduce that down to, say, 40, 50, 60 kilograms a day, you can see how fast the work would go. But we're in that process where you just have to do the work. You have to be able to get the results that you certainly expect to get, and I think we will. There is no reason not to, and then we're going to have a different story to tell out there once the pilot plant's complete, and of course once we've refiled the shortcomings in our patent application, and the shortcomings were to do with syntax and wording, and but it was 70 items, and it was tedious to do that, and that's all been sent back to the patent office, and we hope that we can move ahead from here. It may have a few more requirements, but if that happens, there's nothing we can do about that. It's out of our hands. Once it leaves the drawing board here and goes into the patent office, and we just have to hurry up and wait. But I want to remind everybody that we've got a what I think could be a very important show here in Richmond with Chinese investors on the weekend. We're hoping, I guess, the sponsors of the people that sponsored the show are hoping for a turnout of between 300 and 500. That would be optimum because we get an opportunity to talk about our process there. And from what I understand, the Chinese are moving away from real estate for obvious reasons. It's overheated. And, they have some penalties on them when they buy real estate in BC. So, they're looking at the markets, and I'm hoping this is an opportune time for us to create a good Chinese following. If you remember my comments from the San Francisco show, we had more interest from the Chinese investors, the local ones from San Francisco, than we did in the other various groups. So I'm hoping that we get a real good response at this Saturday show that's, tomorrow. And that the shareholders all benefit from that. Jim, I guess that's my message. I mean, everything's overshadowed by the stock market right now, but, it's not opportune for the show either, because a lot of people will stay away when the markets are correcting because they go to the sidelines. But I'm still hoping for a good turnout, and I don't see the usual panic in this market any other time that it's fallen this precipitously. There's a lot of panic involved, and I don't see that this time. So let's keep our fingers crossed and move onward and upward.
Larry, how can people get a hold of you, and where are you traded?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Germany under the symbol 2AM. And they can do due diligence on the company at our website, which is chock full of information at AmericanManganeseInc.com, or they can phone us here at 778-574-4444.
Larry, have a great weekend.
You too, Jim.
I'm Jim Goddard. I've been speaking with Larry Reaugh, CEO and President of American Manganese. Our conversation took place on October 12th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.